Okay guys, in this trading example, we're taking a look at an ES short off of a 2 time frame chart setup, a 60-minute and a 15-minute. And things to keep in mind in this particular example, like in every trade, we look for time frame confluence, meaning we need the opportunity, the market to set up on multiple time frames to add to the conviction of the trade, basically confirming what we're seeing and what we could see. Also, there was a big drop from the area that we were looking to short at, and that's why it was the area that we were looking to short at, because there was a big drop from that particular price level. And then finally, the risk to reward ratio was over 4 to 1 to the downside, and so anytime you have something, really over 3 to 1, you're in good shape, and those are the type of opportunities you want to be taking. So let's get right into the charts and take a look at the examples. And if you need any review for this example or any of the examples in these videos, just review your derivatives day trader course, and for this example, review parts 1, 2, and 4. Okay, here we go. So in this example, again, we have a couple things that are adding up to create the opportunity for us, right? So we have the 2 time frames, the confluence from that, the big drop from our area, and then the risk to reward potential was definitely in our favor at a plus 4 to 1. And in this setup, we were looking for price to continue to move down based on a weak market environment and lots of profit potential to the downside after a strong move up back in price to the area of basically the origin of that drop. Again, there's that weak market environment. I know we've talked about that in previous videos. Knowing your trading environment is half the battle in figuring out what side of the trade you want to be on and what type of opportunities you want to be looking for, right? So you're going to hear me talk about the trading environment quite often. The area of interest that we were looking for, again, was on 2 time frames. It was a previous area of demand or support, if you will. Buyers had come in right in here and pushed prices back up towards the highs before failing. This is where prices failed at this area where buyers were previously in control. They were no longer in control, and sellers were in control, creating this big drop. So once we got a rally back up into this area, we were looking for a shorting opportunity. There's our 2 time frames, the 15 and the 60. We want to have it at least on 2 time frames. If we have it on more, then that's great. That just adds further confluence. We're always taking a look at bigger picture, like the dailies and the weeklies and the higher time frames. But when you're about to enter an opportunity and enter a trade, you want to have it on at least 2 time frames. That's what I find. That's where we find the most success, is definitely taking trades that have that confluence. We actually won't take a trade if it's just on 1 time frame. I won't say we won't, but those are going to be more aggressive type of trades, and they're going to be on the smaller time frames. But in the end, really, we're using the daily, whether we're day trading or swing trading or position trading, we're still using the daily chart to kind of dictate what we're looking for. So even on a 5-minute or a 2-minute or a tick chart, you're still kind of using that market environment and big picture when you're trading, even on those smaller time frames. Okay? So that previous demand area, previous area where buyers were coming in, now sellers were in control. The size of the drop was very nice, meaning that the profit potential once price retraced back up here was very good, and that's where the risk to reward ratio comes in of over a 4 to 1 risk to reward. And so that's what really created this opportunity. It's not much else. There's a few things that go into consideration, that we take into consideration, and in certain trades and certain market environments, we take more things into consideration. It just really depends on where the market is, where price is at relative to these things, these factors that we take into account, right? So on the 60-minute, nice big drop out of here. Plenty of profit potential. You can see that. plenty of room for prices to retrace. We have our 2 time frames, and the risk to reward was big. But most importantly, what caught our eye from this level and why we chose to short at this particular price or area was because buyers had previously stepped in right here and taken the market up from this level. And then once prices came back to this level, the buyers were no longer there. They tried to keep prices up. You can see they pushed prices back up after dropping even lower out of this area, but that gave us the indication that the sellers were in control, if you will. And then once we finally did get that drop out of there, it was simply a waiting game. And that's what you have to do a lot of the time in trading, is wait for price to get to an area that you want to either buy at or sell at. And that's where a lot of people get into trouble and overtrade or lose focus. And that's when you're waiting for prices to get to a level that you deemed appropriate to either buy or sell. No successful trader is sitting here buying and selling each and every tick on each and every move. You have a defined set of criteria that you want to establish, and that's from watching the market, trading, learning what to look for, and then repeating it, making sure that you have it down in a set of rules on paper that you follow. And this takes time to do that. It takes time and basically screen time to understand what the market's telling you, what it may do next, where it may go, how much profit potential you have, how much you have to risk. All of that is done by understanding what you're looking at on a chart. And that's what we do here at Simply Derivative. Okay? So that's it for this example. It's not a long one. It's not overly complicated. It's really basic. Let's go over it one more time. Multiple time frames. We have a 60-minute and a 15-minute. Again, at least have 2 time frames for that confluence. Right? The profit potential is big. Profit potential is big. Why? Well, prices fell in a dramatic fashion, in a strong way, in a strong move out of this area. So we simply were waiting for prices to retrace back up to this zone and then short. Old support becomes new resistance. That old adage. Well, it works. Not all the time. You know, we obviously have our own things that we take into consideration and don't simply just sell or buy all the time at old support or old resistance, if you will. So it's just something that we need to add to our list of things that we're looking at. And then that profit potential is there, like I said, the big drop from that area, multiple time frames, and that's really it. You can see we made some money on the trade, and there was definitely a good opportunity. And again, these are the type of things that we're looking for each and every day, the type of setups we're looking for each and every day. It doesn't happen every day, but there's plenty of markets out there, and this type of analysis that we do and how we trade can be applied to not only futures, but also stocks and options, currencies, crypto, Forex, all that good stuff. So yeah, like I said, hopefully this example gave you some insight into how we read charts and the type of opportunities that we look for. And if you guys want to know more, definitely check us out at simplyderivative.com. And if you have the course, the Derivatives Day Trader course, and you need to review any of the things that are on this screenshot, on this chart, anything that we've talked about in this video, go back to parts 1, 2, and 4 and brush up, and you should be good to go. All right, guys, we'll see you on the next one.